Welcome back to America's Retirement Headquarters, the home of the Retirement Guys formula and America's Medicare Associates with Nolan Baker. ARHQ.com is the website. The phone number is 419-794-3030. If you just joined us, missed the first half of the show, you want to catch up on previous editions of the show or other topics we've talked about through the history of America's Retirement Headquarters, available wherever you consume your podcasts, Apple Podcasts, Spotify, and go to YouTube. Just search for America's Retirement Headquarters, all there for you to check out at your leisure, whenever you'd like to. Now, a stock market bubble is something that happens when share prices increase rapidly beyond the value of companies. Financial author Harry Dent tells Fox Business, we've been experiencing a run-up that, quite frankly, might burst pretty soon.
This bubble's been going 14 years instead of most bubbles 5 to 6. It's been stretched higher, longer, so you'd have to expect a bigger crash than we got in 2008 to 9. This thing has got to blow. It's showing signs of topping here, but we've got to see a crash of about 40%. I can tell you there has not been one bubble, and this is far larger and longer, one major bubble in history that has not ended badly, period.
That doesn't sound very positive. Now, when bubbles do burst, a lot of investors, quite frankly, they're caught off guard. How do you guys help prevent clients from becoming victims of a bubble?
Well, I think it's definitely running what's called the fire safety drill. Now is such an important time to be running the fire safety drill before something bad happens in the stock market and understanding not only what you own, but understanding what is your downside risk management program. Now, I was blessed a couple of months ago where I had an opportunity to go out to Yale and interview a couple of professors at Yale, William Getzman and Roger Ibbotson, and get their opinion as far as the outlook of the market. Now, also at Yale is Dr. Robert Shiller, and he's famous for creating what's called the Shiller PE ratio. And so if you look at his PE ratio, what he shows is that the valuations in the market today are actually higher than where they were right before the crash of 1929. So you've got, a lot of the people that are, like Harry Dent talking about the bubble will burst. And I think at the end of the day, they're all right. The bubble is going to burst. The question becomes, when is that going to happen? On the flip end of the scale, it was last year, and last year I remember somebody had come in from one of our financial talks that we had, and he came in and he had shared with me that after the volatility last year in the market, he took all of his money out of the stock market and moved it into bank CDs. Now, bank CD rates are some of the highest that I've seen in 20 years, but the problem by doing that knee-jerk decision of getting out of the market is, he's missed out on such a huge rally that we've had overall within the market. So making that emotional decision is going to be painful. And in fact, whether you listen to, Harry Dent, myself, or anybody else, everybody's willing to give you their opinion about when the market's going to crash, but you have to realize the market doesn't care what my opinion or anybody else is. The market's going to do what the market's going to do. Mm-hmm. And so if we go back and we look at, things in the past, I've been licensed in this industry for 30 years now. And if I think about different market cycles, there can be things that happen that dramatically change the market. So, we saw COVID happen, and, COVID showed that the market could go down the fastest it ever did in the history. We saw 9/11, where the terrorists flew airplanes in the World Trade Center, and then the market immediately collapsed from that. Then we saw other market cycles like the dot-com bubble burst that lasted a couple of years. 2008, that was started in 2007 and went through 2009, a little bit more of a longer cycle. And what I want you to do is I want you to make sure that you understand the market's at record level highs. I'm not saying it's time to panic. I don't want you to panic. And the reason I want you to be prepared is I want you to run the fire safety drill while times are good. That way you know exactly what the strategy is if and when times get bad. There's 4 things that I want you to do. Number 1 is I want you to protect profits and reduce some of the amount of money exposed to market loss. When you look at rebalancing your portfolio, what you traditionally do is a lot of people will have money either in equities or fixed income. So we've seen equities rally very strong, and we've seen fixed income, mainly the bond fund market, to be either flat or slightly negative. So rebalancing your portfolio means selling off some of your winners and buying some of the things that are a little bit lower. It's contrary to what emotionally you want to do. You'd be like, well, why would I sell the things that are doing good and buy the things that are down in price? Because in fact, what you're doing is you're doing the right approach of overall investing, I believe, to help with risk reduction, which is selling high and buying things that are low. It's, again, from an asset allocation standpoint, doesn't guarantee success in the market, but it is a strategy. You can also protect profits, meaning that there are investments that you can take and put money into things that are not exposed to market risk. So in this case, you could take a percentage of the money and you can put it into where we see the high interest money market accounts. Again, FDIC insured bank CD rates are good. A lot of the fixed and index annuity rates are some of the highest rates that I've seen in 20 years in the industry. And by doing that, that's going to ultimately give you some money that's not exposed to market risk. Depending upon what type of an investment that you put it into is going to give you purchasing power. So if and when the market goes down, you have the ability to have some money that you can buy back in, again, depending upon what you put it into. The second thing is you could utilize what we refer to as circuit breakers. And some of the models that we have here at the Retirement Guys Formulas, what we do is we take a look at the moving averages of the market. And based upon where the market is at, as long as we're above the moving averages, that would be an indication that things have relative strength. Technically, things are still strong to either stay or get invested. And then when the market goes below a moving average, that would be an indication where one of our circuit breakers goes off, designed to kind of help protect and try to limit losses by reducing your equity exposure. Most of the people that I meet with that either aren't working with a financial advisor or working with a lazy financial advisor are put into more of a set it and forget it type of an approach. And by that, what I mean is in 401ks, when you have a target date retirement account, it's essentially like putting your plan on cruise control and going the same speed all the time, regardless of what the market conditions are. When you're talking about circuit breakers, what I'm talking about is adding in what I would refer to as a gas pedal in the plan. And so what the gas pedal does is it not only looks at things from a strategic standpoint, it also is going to look at things from a tactical perspective. And it's going to say, based upon the market conditions that are out there, when the market conditions deteriorate, it's going to let off the gas pedal. So instead of going 75 miles an hour, you're going to begin to slow down, and it's going to help you kind of reduce that gas pedal maybe down to 35 or 40 miles an hour. And in terms of driving a vehicle, if you're driving a vehicle 70 miles an hour and you get in an accident, it can be deadly. The same would be true as if your portfolio is invested at a 70 level risk and we have a major economic downturn. I mean, Harry Dent said 40%. That's a huge downturn in the market. Mm-hmm. That could be deadly for a retiree. Where if you had the circuit breakers and you had the ability to slow down your portfolio to, say, 35 miles an hour, at 35 miles an hour, no accident is a good accident, but most likely at 35 miles an hour, it's not going to be a deadly accident. The market has been really, adaptive to the product developments that have come out as well. The third idea to take a look at is what are some of the buffered strategies that are out there. And what there is there's investments within the market that allow you to limit some of the losses or all of the losses that you have based upon using a buffered ETF strategy in exchange for having some type of capped return. So you could say, during the next 6 months, I'm a little bit worried because of the election, the things that are going on. I want to take a position that would help reduce if the market's down over the next 6 months and limit the losses. In exchange for that, over the next 6 months, there's a cap type return that we can have on there. Those buffered strategies are a good way that allows you not to let your human emotions of getting in and out of the market, which a lot of studies have shown that's a very difficult thing to do. You can get whipsawed in a portfolio. Allows you to stay invested. So if the market continues to rise, you can participate in percentage of those gains, where at the same time, if the market does have a sell-off, you can help reduce and or eliminate some of those losses. If you go through this fire safety drill that I'm talking about, the fourth thing that it's going to do for you, it's going to turn panic into opportunity. People get hurt when things catch on fire and they don't know what the exit strategy is. They don't know what the plan is. And I think we see that oftentimes happen with investors as well, meaning that they'll wait until the market has a major sell off. They'll wait till things are bad. They'll take, big bruises in their equity positions, and then they'll ultimately, let their emotions get involved, or somebody talk them into making changes to more of a fixed income type portfolio. Locking in those losses is going to be a painful lesson that too many investors make. But if you know what you own, if you run the fire safety drill, if you have money set aside that you've already pulled out while the markets are at a high, what it's going to do is it's going to allow you to turn panic into opportunity. As we're discussing things with our clients and we're walking through these different strategies on how to kind of help protect them from market crashes and help them understand what they have in their portfolio. If you have these type of strategies in place, and again, on the nightly news, they're talking about the end of the world is here for the stock market. That could be a pretty good indicator for you that maybe it's time to, get together with your advisor and take a look at purchasing equities when everybody else panics. Again, think of investing as buy low, sell high. Markets are at record level highs. Now's the time to run that fire safety drill. This is something that we do all the time for folks. We'd be happy to run the fire safety drill and help you walk through integrating a downside risk management plan in place. So, if you're listening today and I ask you if and when the market has a major sell-off, what changes would be made in your plan, and you say, really none, or you're not sure, you're the type of person that should get together with us so we can run this fire safety drill and give you a little bit more peace of mind moving through these future economic uncertainties.
Because it's really not a question of when it's going to, or if it's going to happen. It's a question of when these market downturns are going to happen and how often over the course of your retirement. You're more than likely going to see more than one market downturn. But if you're positioned properly, if you know how to pivot and, see these panic moments and be able to make opportunities out of them. Warren Buffett famously said, you want to be fearful when others are being greedy and greedy when others are being fearful. It's easier said than done. You might need a little bit of discipline instilled on your side. Let the team at America's Retirement Headquarters help you through that, help you navigate whatever is coming down the line when it comes to the markets and volatility. And rest assured, there will be volatility over the course of your retirement, but hopefully you won't have to feel the effects or make those knee-jerk reactions. 419-794-3030 is how you get started, how you run that fire safety drill with the team at America's Retirement Headquarters. You can also reach out, find out more about them, and schedule a time as well at arhq.com.